I have to admit, when I first saw the financial headlines this morning, I actually refreshed the page.
Hmm.
I thought there was, a typo in the data feed.
It definitely makes you do a double take.
Yeah.
We've spent the last, 3 or 4 years talking about trade wars and rising barriers.
Protectionism.
Yeah, so seeing a number go down,
Yeah,
and I mean drastically, feels almost unnatural at this point.
it really does. So we are talking about the United States slashing tariffs on Indian goods.
Hmm.
And slash might even be too soft word. We're seeing duties drop from a crushing 50% all the way down to 18.
That is a massive, massive delta.
Yeah.
I mean, to put it in perspective, in international trade, a 5% cut is usually a breakthrough.
Okay.
A 32% cut is a structural shift. It completely rewrites the profit and loss statements for hundreds of companies, like overnight.
And that is exactly what we're here to unpack today. We're not just looking at the headline number.
Right.
We're digging into a really comprehensive strategy report from ICICI Direct that looks at the fallout. Their mission, and ours, really, is to figure out who actually makes money from this. Because when the rules of the game change this much, there are going to be some very specific winners.
And losers, relatively speaking, or at least competitors who are suddenly on the wrong side of a pricing war.
Exactly.
And what's interesting about this ICSCI report is it doesn't just list stocks, it builds a whole thesis around what it calls restored competitiveness.
What does that mean exactly?
It basically argues that Indian exporters have been fighting with one hand tied behind their back, and now suddenly the ropes have been cut.
So before we get to the specific companies, and there are some fascinating names on this list, we really need to set the scene. How did we even end up with 50% tariffs? It feels like things escalated really quickly in 2025.
They did. It was a classic tit-for-tat escalation.
Yeah.
The Trump administration pushed what they called reciprocal tariffs.
Right, I remember that term.
The logic was pretty binary. If you tax our goods, we tax yours to match. The goal was just to hammer down the U.S. trade deficit.
But 50% seems incredibly high, even for that kind of policy.
That's where the geopolitics came in. The report explicitly notes that the spike to 50% wasn't just about economics. It was cited specifically because of India's continued purchase of Russian oil. That was the real friction point. The U.S. used that tariff wall as a lever.
And now that wall has come down to 18%. So we have to assume the geopolitical tension has cooled off, or at least the economic argument won out. But here's the question I have. Why 18%? Is that actually low enough to matter?
That is the most important question. Because in a vacuum, 18% is still a tax, right?
Sure.
But you can't look at it in a vacuum. You have to look at it relative to the competition.
Right.
If you're a U.S. buyer right now looking to source, say, chemicals or textiles, you're looking at a global menu.
Okay, so let's look at the other prices on the menu.
So if you buy from China, under the current framework, you're getting hit with a 47.5% tariff.
Wow.
If you buy from Brazil, it's 37%. Even Vietnam, which has been the manufacturing darling for the last few years, is facing 20%.
So at 18%, India has effectively become the cheapest credible option.
Precisely. We've undercut the competition. It's not just that our goods are cheaper than they were yesterday.
Right.
It's that they are now cheaper than everyone else's. And that's a competitive moat.
And the market strategists are clearly excited. The macro numbers in this report are incredibly bullish. They've set a 12-month target for the Nifty at 29,500 and the Sensex at 98,500.
Those are ambitious targets.
Yeah.
They're valuing the market at about 21 times FY28 earnings. But what really caught my eye is that they expect the real juice to be in the mid and small cap sectors in 2026.
Why is that? You'd think the massive conglomerates would be the first to win?
Well, they argue that the valuations in the mid-market are just more rational right now. But more importantly, these are the companies that are agile enough to pivot their export strategies quickly.
Ah, okay.
The giants move slowly. A mid-cap auto component maker can shift production lines in a quarter.
Speaking of which, let's dive into that first big sector, automobiles. I feel like there's a bit of a trap here for the casual investor, though.
How so?
You see tariffs down, you immediately think, buy Tata Motors or buy Maruti, but the report says, hold your horses.
Right. If you buy the OEMs, the original equipment manufacturers making the full cars, you might be waiting a long, long time for a payoff.
Because of the fine print.
Exactly. There's a U.S. regulation called Section 232. It applies a blanket 25% tariff on national security grounds to finished cars and light trucks.
And that rule is still in place.
Still in place. The 18% deal we're talking about applies to the reciprocal tariffs, which covers components and parts.
So if I'm shipping a finished sedan, I still pay 25%. But if I'm shipping the axle that goes into a truck, I pay the new 18%.
Correct. And that's why the report is basically screaming, buy on the ancillary companies, the parts makers, and staying neutral on the car makers, at least for U.S. exports.
Okay, so let's talk about the biggest winner in that space, Farad Forge.
This is the poster child for this trade deal.
Huh.
Farad Forge is India's leading metallurgy player. They make the heavy forged parts.
Right.
But look at their revenue mix. Nearly 50% of their standalone sales are exports, and a massive 70% of those exports go to North America.
So they're basically a U.S. industrial supplier that just happens to be headquartered in Pune.
Essentially, yes. And they're heavily exposed to Class 8 trucks, those massive 18-wheelers,
The backbone of U.S. logistics.
the absolute backbone. That specific category falls under this tariff reduction. So their products just became significantly cheaper for U.S. truck makers to buy. ICICI upgraded them to a target of 1,850.
That makes a lot of sense. Who else fits that heavy machinery profile? I see Balkrishna Industries on the list.
Yeah, they operate in this fascinating niche called off-highway tires.
Off-highway, like for dupe bikes.
Bigger. Much, much bigger.
Okay.
Think of those house-sized dump trucks you see in mining, or massive agricultural tractors. Balkrishna is a global leader in tires for those beasts.
Got it.
The U.S. is about 15% of their sales. Since those tires are industrial components, they get the benefit. It's a direct margin boost. The target there is 2,885.
Then there's steel strip wheels. Now, this is a company I know has been struggling a bit.
They've really been in the penalty box. Exports are their main growth engine. About 65% of their export volume goes to the U.S.
So when tariffs spiked to 50%?
They were just priced out of the market. They couldn't compete. It was that simple.
So for them, this isn't just a boost, it's a lifeline.
It's a complete reversal of fortune. It acts as a relief valve, letting them re-enter the market competitively. The target is 260.
And rounding out the auto list is Sincera Engineering.
Precision forged components.
Yeah.
They have about 9% exposure to the U.S., so it's less dramatic than Farad Forge, but still a solid play on the whole sector's recovery. Target is 2,130.
Okay, let's shift gears from heavy metal to fabrics. The textile sector. This feels like an area where every single penny really matters.
Oh, it's a brutal industry. It's a volume game with razor-thin margins.
Yeah.
A 2% difference in duty can lose you a contract, so a 32% drop.
That changes everything.
It changes the entire global sourcing map.
The report mentions India already has about an 8% share of the U.S. textile import market. That's a $102 billion pie, so 8% is not small.
And the momentum is already with us. Post-COVID, India has increased its market share by about 500 basis points.
Mm-hmm.
And in that same time, China's share has dropped by about 600 basis points. We were essentially eating their lunch.
And this tariff cut is like adding hot sauce to the lunch?
Yeah, exactly. Before this deal, we were competing against places like Vietnam and Bangladesh, who had better tariff rates.
Yeah.
But remember the new math, right? India is at 18%.
And they're not.
They're still facing rates between 20 and 30%.
Oh, we've gone from being the quality but slightly more expensive option to the quality and cheapest option.
Which is a deadly combination for our competitors.
Mm.
The company best positioned to capitalize on this is Gokaldus Exports.
Why them specifically?
Just pure concentration.
Yeah.
They're one of the largest apparel exporters to the U.S. We're talking more than 80% of their revenue is from U.S. exports.
Wow, that is putting all your eggs in one basket.
It is, but right now it's a golden basket.
Okay.
They're levered to this trade deal more than almost anyone else. Plus, they've got new deals in the UK and EU. The report has a target of 929 for them.
I was also really intrigued by Indocount Industries. I had no idea they were the world's largest manufacturer of bed linen.
They're the kings of the bedroom, globally speaking.
Mm-hmm.
70% of their product goes to the U.S. But what I like about them isn't just the tariff cut, it's their business evolution. They're moving away from just selling basic white sheets into what they call fashion bedding.
Fashion bedding. Is that just a fancy marketing term for colorful sheets?
It's a term for higher margins. It means
Yeah.
comforters, utility bedding, decorative pillows.
Ah, more complex products.
Exactly. Products that command a premium price, and by moving into that, they expanded their addressable market from $4 billion to $15 billion.
And now they can price those premium products more aggressively. They can go steal market share directly from the Chinese luxury bedding makers. Target price, $370.
Very smart pivot. The report also groups Pearl Global and KPR Mill in here.
Yeah, Pearl Global is the diversification play. They have factories in Bangladesh and Vietnam too, so they're hedged. And KPR Mill is the vertical integration play. They do everything from growing the cotton to stitching the shirt. That fiber to fashion control gives them incredibly resilient margins.
Let's move to a sector that, frankly, has been a disaster zone for investors lately. Chemicals. Disaster is a fair description. I mean, the chemical sector has been hit by a perfect storm for about 3 years. You had a global slowdown, raw material prices going crazy, and then the big one, Chinese dumping.
Can you explain that part? We hear that term a lot.
Sure. China basically overbuilt its chemical manufacturing capacity. So when their own economy slowed down, they had all this extra product.
And nowhere for it to go.
Right. So instead of shutting down factories, they just flooded the global market with it at rock-bottom prices. It made it mathematically impossible for Indian firms to compete.
And on top of that, Indian firms were getting hit with high U.S. tariffs.
Exactly. But this deal just flips the entire script. This is where that 18% versus 47.5% comparison is most potent.
Because Indian chemicals are now just vastly cheaper.
Vastly cheaper than Chinese chemicals. It creates this massive pricing umbrella.
So the Indian companies can finally breathe.
They can do more than breathe. They can go reclaim market share. The report picks out 3 main beneficiaries. Finati Organics, with about 20% U.S. export exposure. Fine Organic Industries, closer to 30%. And Gujarat Fluorochemicals at around 18%.
These are all companies that were probably priced out of the U.S. market last year.
Absolutely. Now they're back in the game. And the targets are significant. 1,994 Finati, 5,365 for Fine Organics, and 4,345 for Gujarat Fluorochemicals. It's a relief rally, but it's backed by fundamentals.
Now, I want to talk about the sector that defines modern India, tech. But the report splits this into 2 very different buckets, IT services and EMS electronics manufacturing services.
It has to, because IT services companies like TCS, Infosys, they don't export physical goods.
Right.
You don't pay a customs duty on a line of code you send over the cloud. So for IT, this deal isn't about saving 32% on taxes.
Then why are they even in the report?
Because of what the report calls geopolitical comfort.
Which sounds like a diplomatic way of saying, we're friends again.
Exactly. Think about it. If you're a CEO in New York and your government is in a trade war with India, are you going to sign a 5-year billion-dollar contract to outsource your critical AI research to Bangalore?
Probably not. You're worried about visas, data restrictions, all of it.
Right. So the trade deal acts as a green light. It signals alignment. It tells U.S. clients that it's safe to loosen their tech budgets and send that work to India.
And TCS seems to be the main beneficiary of that sentiment.
TCS is going all in on AI. Their annualized AI revenue is already at $1.8 billion.
Wow.
But the stat that really blew my mind was their infrastructure play. They are building a 1-gigawatt AI data center network with TPG.
Hold on, a gigawatt. That's enough power to run a medium-sized city.
It is massive scale. They aren't just writing the software, they're building the physical engine room for the global AI boom. The target is 3,780. Then you have LTI Mindtree and Persistent Systems, both chasing high growth. Persistent has a goal of hitting $2 billion in revenue by FY27.
So IT is about the vibe and the relationship. But EMS, electronics manufacturing, that is about physical goods. That's where the tariff actually bites.
This is the China Plus One strategy in action.
Yeah.
Global companies know they can't rely on China anymore. They need a new factory. And India is standing there saying, make it here.
And with tariffs at 18 versus China's 47.5, the math is undeniable.
It's a no-brainer. Dixon Technologies seems to be the name everyone talks about here.
The heavyweight champ.
For sure. They're manufacturing Motorola smartphones specifically for the U.S. market. Their goal is to get their export contribution up to 15–20% of revenue.
And this tariff cut makes those made-in-India Motorola's much cheaper for American consumers.
Which drives volume for Dixon. The target price is a staggering 13,000 rupees. But you also have to look at the components inside the electronics.
Which brings us to Keynes Technology.
Yes. They are investing over 3,300 crore into OSAT.
Okay, break that acronym down for us. What is OSAT?
It's outsourced semiconductor assembly and test. So think about a silicon chip. When it's first made, it's incredibly fragile. It needs to be packaged, tested for defects, and put in a protective case before it can go into a phone or a car.
So it's the last mile of chip making?
Exactly. And Keynes is partnering with U.S. firms to do it here in India. It's high-value work. Target is 4,900.
It really feels like we're seeing a complete ecosystem form. We aren't just assembling parts anymore. We're doing the testing, the design, the whole chain.
Which brings us to the final piece of the puzzle. You can't have an export boom without a support system. You need factories, you need machines, and you need ports to ship this stuff.
The report calls this the support system: capital goods, real estate, and logistics.
Let's start with capital goods. If factories like Barat Forge or Dixon are running at 100% capacity to fill U.S. orders, they need machines, air compressors, power systems, heat exchangers.
There's a great story in the report about LG Equipment's here.
I love the LG story because it's about resilience. They make air compressors vital for any factory. When tariffs were high, above 25%, LG didn't leave the U.S. market.
Okay.
Instead, they just brutally cut costs and optimized their efficiency just to survive.
They learned to run incredibly lean.
So lean. Now, the tariff drops to 18%. They don't need to pass all those savings to the customer because they're already competitive.
So that tax cut flows straight to their bottom line as pure profit.
Exactly. It's the payoff for sticking it out. Target is 610.
And then there's Anoop Engineering making heat exchangers. They're actually setting up an office in Houston.
Getting closer to the customer. Lower tariffs mean their heavy equipment lands in Texas at a price that can beat the local competition. Target, 2,600.
But all these new factories need land. Which brings us to real estate. It seems indirect, but the logic holds up.
It's a classic second-order effect. The report highlights Mahindra LifeSpace. They're sitting on over 1,500 acres of industrial land in key hubs like Jaipur, Chennai, and Pune.
So if a U.S. company decides to move manufacturing to India, Mahindra is the landlord they have to call.
Precisely. They estimate the potential to generate 5,000 to 6,000 crore in revenue just from that land bank. Target is 550. And don't forget DLF in Gurgaon or Lodha, who are selling land specifically to data center operators. It all ties back to that AI theme.
And finally, you have to move all the goods. Logistics.
Volume growth equals port growth. It's a simple equation. Adani Ports is the giant. They handle 27% of India's total cargo. If exports boom, Adani wins. Target, 1,760.
And JSW Infrastructure is the challenger.
A very fast challenger. Their logistics business is projected to grow at a massive 144% CAGR. They're aggressive, and they're expanding capacity specifically to handle this kind of trade volume. Target is 370.
So when you step back and look at this whole mosaic: auto parts, bed sheets, chemicals, chips, ports, it feels like so much more than just a trade deal. It feels like a structural shift.
That's the real aha moment, I think. It's not just the taxes are lower. Is that this deal cements India's place as a trusted strategic partner to the U.S. We're actively replacing China in key supply chains.
Right.
The U.S. is saying, we need a new factory for the world, and we choose you.
Right.
That's a long-term tailwind that goes way beyond next quarter's earnings.
It's a geopolitical realignment disguised as a tax cut.
Perfectly put. And if I can leave you with one provocative thought to mull over.
Please do. What's the next domino to fall?
We've spent this whole time talking about the public market stocks you can buy today. But think about this. With tariffs this low and the geopolitical welcome mat rolled out, how long until we see the private moves?
What do you mean by private moves?
I'm talking about massive U.S. manufacturing ecosystems physically relocating, not just outsourcing an order to Dixon, but a Tesla or an Apple moving entire supply chain clusters to India.
Wow.
We're seeing the exports now, but the physical infrastructure shift, the actual relocation of industrial bases, that might be the next wave.
That would fundamentally change the labor market, the real estate market.
Yeah.
Essentially, the entire economy.
It would be the difference between renting a factory and owning the Industrial Revolution. That's what I'll be watching for in the next 12 to 24 months.
That is a huge concept to chew on, from selling parts to hosting the ecosystem. Well, there you have it. A drop from 50% to 18% isn't just a number, it's a signal. Whether you're looking at Barat Forge's trucks, Indocount's bed sheets, or the ports shipping them out, the opportunities are specific and they are significant.
Indeed, it is a stock picker's market right now.
As always, take a look at your own portfolio and think about how these macro shifts might affect your strategy. Thanks for joining us on this deep dive into the U.S.-India trade deal. We'll see you next time.